good afternoon, good evening, wherever you are in the world. I want to say thank you so much for tuning in and joining me. Listen, I have some idea that I want to share with you, so indulge with me as I go through this process with you. Hey, for those of you that don't know me, my name is Douglas Eze with Lago Financial Services. I've been in the financial service industry for going over 20 years. I'm so excited, so blessed with the knowledge that I have, that I'm willing to share with you to help you grow and make sure you continue to grow your wealth. Because the last thing I want is for you to not accomplish those things that you want accomplished. So here we go. So here's an example of somebody that wants to buy a car, and because they have bad credit, I've got people call me and say, Douglas, you always talk about people with good credit. How about somebody that has bad credit? Well, the good news is the program I'm going to show you in a few minutes will help you, even if you have bad credit. But let's say you went out and you purchased the car for $12,800, and because of your credit, they charge you a 23.7% interest rate. And I put that amount because that's a number that I've seen people have. Okay, they charge you 23.7 and your monthly payment is 517 because the finance guy told you that you can finance it for 36 months so that you could pay it off quickly. Of course, they want you to do that. You're going to get financial advice from so many people, you know, the car company, the mortgage company, your tax person. Everybody's going to give you financial advice. But remember this, are they advising you for you to benefit you, or is it to benefit them? Understand it. When a financial institution is giving you financial advice, they're giving you advice to benefit them. So when you finance your debt for 36 months, it's a lower payment, it's a higher payment, of course, $517 with a lower term in years, right? And they tell you, oh, you only pay $5,206. See, if I was in your shoe, what would I do as Douglas Eze? Guess what? If I was in your position, I would finance the debt for the longest term, 84 months. Guess what? I pay less out of pocket. See, it's the money I'm paying out of pocket that matters. It's not the interest rate or the years. It's the money that I'm coming out of my pocket that matters. Because I could use the other money to go work for me and make money for me. Always remember this in life. There's a term we call opportunity cost. What does that mean? For every dollar that you could have saved, but you end up spending that dollar, imagine how much it'll be worth for you in the future. Always remember that before you make any major financial decision. What is the opportunity cost on this dollar? So in my case, I always look at can I do it for longer? And they say, yes, you can do it. Then I focus on what is coming out of my pocket, because this is my wealth. This is my income that I'm using to pay this. So I'd rather pay it with a lower income and take the difference and invest it. But we won't talk more about that. So I'm going to bring this guy back to 36 months. So it drops the payment. Makes the payment $500. So that's the advice you got, and you thought they gave you a good advice. No problem. You're going to pay them that. Now, let me flip it to this right here. So here's what the banks do. So in the traditional world, what happens? You make your income. Some of you have seen this picture 1,000 times over. You make income, and what happens? You contribute money to this tank right here, right, from your job. And because again, I'm talking to you, middle income America, and what happens? The IRS take taxes out because they don't trust you to send them the money, so they take the taxes out. So now what happens here is this: you are saving in your 401k account because you didn't pay taxes, so the IRS also has a portion of that money belongs to the IRS based on your tax bracket. All right, depending on how much you have in there. Now, after you pay the taxes, you have some money left over from your income. You're like, okay, should I save some more money? Well, before you're making that decision, because it's a long journey as you think about it, some financial advisor calls you and say, hey, you need to put some more money in a mutual fund. You say, oh, really? Where's that? Should I put it here? No, don't put it in your savings account. Put it in a mutual fund account, and you put it back into a risk tank. So let me paint that picture. And the risk tank is that yellow guy right there. Now understand this. When the market tanks and everybody's losing money, you lose money in your mutual fund, and you also lose money in your 401k. So my question to you, how have you diversified your portfolio? All these so-called financial gurus are telling you to continue to put money in the stock market or the mutual fund, and you listen to them, and you've already put money in the mutual fund and the stock market inside of your 401k account. Now they have you put it again inside another mutual fund account outside of your 401k account. I don't like that at all. That's not what I'm going to teach you. And if I had my way, I wouldn't even put any money in this account. But listen, we're going to play it safe today. I don't want to get into that fight because I'll knock somebody out. But check this out. So this is what we do. And now you say, okay, well, I'm already saving here. And what happens, I also want to put some little bit of money away because you know you've been doing your right thing. So you save a little bit of money here in your safe account. But because the interest rate is so low that it's ridiculous, your money takes a little bit of time to grow. Now, what happens next? You want to buy a car, and you go to the bank and say, I need money to buy a car, and they loan you money to buy the car. But guess what they do? They use your future income to loan you the money, so you have more debt than the amount that you have in your savings account, and more debt than the amount you have in your risk account. So because you're using your future income to pay for the car, this is what's happening. Again, you're in that position. You make your income, you're contributing to your 401k, you're making money. The IRS takes their taxes out. The rest of the money flows. I'm going to put in two situations because you have the savings going in here, your mutual fund account. You also have your savings going in here, and you're also paying debt. Sometimes you don't even have any more savings because you're using the money to pay debt. So that goes in to pay your debt because you couldn't save anymore. Sometimes you even stop contributing. So let me even do it that way because I know so many people do that, right? Sometimes you even stop contributing. The only place you're contributing to is your 401k, and the rest of the money is after the IRS takes their portion out. We can never forget them. And instead of you can't save up there, you're like, no, I can't save. I need to pay for this debt that I've acquired. So you start paying down the debt because he's like, and because you listen to Dave Ramsey, he said, you know what? Pay down your debt first, and you pay down your debt, and then you can start saving. What a bad advice. But, you know, he's helped so many people get out of debt. We can't blame him on that. It's good, but they go broke afterwards. Now, check this out. So here's my system. This is my system. Totally different set of thinking. So the first thing I say to you is I said, listen, you have your income, right? Yes. Okay, good. Do up to the match. Don't do anything over the match. Do up to the match. Put in your 401k. If you don't have to put it in there, don't. I don't even, you know, I really don't want you putting money in a 401k, but I'm going to leave that conversation to somebody else. The next thing we're going to do is we're going to pay taxes, of course, to the IRS. Now, what I want you to do is instead of you contributing into this tank, remember that mutual fund? So I'm going to take that away from you. I'm going to remove that. And I'm going to come back here and take that money and put in here. But not your savings, your traditional savings. We're going to change this to your life insurance savings account. So the life insurance company receives that money. Now, when you want to buy the same car, guess what? You go to the life insurance company and borrow the money against your policy. They're going to charge you interest just like the bank is going to charge you interest. And yes, they all charge interest up front in advance, depending on the type of policy. Whole life policies charge it to you advance. Universal life IULs charge it to you on the anniversary. I'll do a whole training on that. But let's say this is a whole life policy. They charge it to you because we like to use our whole life insurance for savings and emergency account. That's what we use our whole life insurance policy for savings and emergency account. And the right type of whole life policy. So understand this. So the insurance company charges you the money. They use your life insurance as collateral, the cash value in your life insurance as collateral. But you're still pumping money in there. And then what happens is you do what? You pay back the loan. The same way you're paying Bank of America for the loan, you start paying your insurance company back. And guess what? This goes away, and goes away, and you still have your full cash. Now, let's go into a real life situation. So I hope you can see the screen. So this person here took a loan from the insurance company for $12,800. They charge them interest advance, and it's $543. So it's about 4 point some % interest rate. $543. So it doesn't matter what kind of credit you have. As long as you have cash in your life insurance policy, the insurance company will loan you money. So this person took out $12,800. The insurance company charged them $543 in advance. But the client starts paying back the loan, $500 back to the insurance company, and they reduce the interest on the loan. See, they gave back the interest, $18. That $543, they refunded it back on that dollar amount the client paid back. Same thing the next month, same thing. Next month, same thing. They keep doing that because remember, as you're paying down, they're doing it's amortized, right? Up front $543, they charge you, but then they start paying you back little by little, because at the end of the day, when you divide up the amount, you don't owe. When you pay $500 back and you got back 18 the first time, so now you owe 12,300. So the interest is based on that now. So that's how they're doing the math on that. That's why it's various numbers and it's going down. And then finally, this person dumped a big, huge chunk of money, $7,000 loan repayment, and they reduced this to 106. And it goes on. This was end up in December. Of course, just using that example. But my point here is the insurance company, when you borrow money from them, they refund you back the interest. Now, let me ask you, gentlemen and ladies, when you pay back your credit card company, or the car company or whoever, do they give you back this interest? Do they give it back to you? Let me wait for the answer. No, they don't give it back to you. You don't get it. So, my friends, understand this. I wanted to do this so that I could help you get your mind right, understanding some concept. If you want to know more, please click the link, schedule an appointment with me so I could help you navigate your finances and help you plan properly. When you know better, you do better. Again, thank you so much. Follow me on YouTube, follow me on Instagram, follow me on Facebook, and let's continue to empower ourselves and empower our future. Thank you so much. Have a great week, and bye-bye.